Good afternoon. My name is Phil Diorio, and I'm the lead portfolio manager for the NCM Core Global and Core International Fund. Today, I'm going to give you an update on our mandates. And specifically, what I'd like to talk about is our performance, a little bit of an update on some of the changes that we've made to our portfolios, and why we feel better about the way our portfolios are positioned on a look-forward basis. So looking back on this year, the returns from market have been disappointing. There haven't been a lot of places to hide. Our portfolios have not met our returns, and I wanted to talk about some of the reasons for this. First of all, there's been the underperformance of the quality factor. There has been mass selling of European equities, and there's also been some currency impacts. So starting with the quality factor, my investment philosophy is a quality-based process. I'm looking for companies with strong moats around their business, high barriers to entry, companies that can generate high returns on invested capital and generate a lot of cash and do so with strong management teams and robust balance sheets. As you can see here on this slide, quality has outperformed over very long periods of time. There's two indexes on this page, the MSCI All Country World Index, and then the MSCI All Country World Index Quality Factor Index. And whether you look at 3 years, 5 years, 10 years, or even going back to 1994, when these indexes were created, quality has consistently outperformed. However, this year has not been a typical year. Quality has not only underperformed, but it's underperformed materially in what is typically a good time for quality. As you can see on the slide here, during past drawdowns, quality has typically outperformed the broader index by about 600 basis points in 4 of the last 5 major drawdowns. And in the other instance, in 2018, the quality index performed almost in line with the index. However, this year, quality is underperformed by about 400 basis points. And that was during the first half of the year when the quality factor underperformed the most. That's when most of the damage was done. And so one of the main reasons for this is that quality companies trade at higher valuations because they have those higher returns on capital, those higher returns on equity. They generate a lot of cash and have clean balance sheets. They get accorded higher multiples by the market. However, this year has been a different year. The 10-year yield has more than doubled, starting the year off at about 1.5%, increasing to 3%, and more recently hitting 4%. And so when that happened, there was a big compression in PE multiples in the market, and quality companies got hit the hardest because they traded higher multiples. And so that has been a factor in terms of why our returns haven't met our expectations. There's also been a lot of outflows out of Europe, as everyone knows. There's a war going on over there. There's an energy crisis. It's been a tough economy even during good times. It never grows quite as quickly as the US or other parts of the world. So given what's happening now, there's been a mass exodus of outflows from equity funds, totaling about $30 billion so far, which is the most since 2016 when we had the Brexit. Finally, there's currency. As you can see here, the US dollar has appreciated against the Canadian dollar by about 8.5%, which has helped our portfolios. But the other currencies have more than offset what's happened with the US dollar, with the euro depreciating, the yen depreciating, and the British pound also depreciating. This has been especially hard on our international portfolio, which invests outside of North America. So next, I just want to talk about some of the changes which started back in February when we started to realize that inflation data wasn't getting better. And then there was the outbreak of the war. At that point, we felt that the environment had changed, the risks were higher, the potential range of outcomes for the economy and the stock market were also getting wider. And so we made a lot of changes starting in February and continuing over several months. We sold a lot of companies in cyclical sectors, banks, communication services, consumer discretionary. Some of the names here you can see in front of you, Comcast and Facebook, JP Morgan and Silicon Valley Bank, Taiwan Semiconductor and Adidas. In a lot of cases, the names that we sold fell on the order of 25, 30% or more since we sold them. On the buying side, we reallocated a lot of the money from those sales into more stable companies in sectors such as consumer staples and healthcare. These sectors are more stable, but they also have lower earnings downgrade risk. So when you start to get into an environment where you're worried about a recession, the stability of these companies is better than what you saw on the former page. So companies like Diageo and Nestle, which we've spoken about before, we've been adding to those names. And then we also bought some new companies, Pro Ricard, which is the number 2 spirits company in the world. Heineken is the number 2 beer company, and AstraZeneca is a leading pharmaceutical company. So in terms of why we feel better about our portfolios looking forward, first and foremost, the valuations for our holdings look a lot more attractive than they did at the beginning of the year, given what's happened in the market this year. Secondly, we feel that portfolios are a lot more resilient given all of the changes that we've made to them, which I've just described. Also, sentiment measures are extremely washed out. Recent sentiment measures are at levels that haven't been seen since the great financial crisis and at the height of COVID pandemic. And finally, 3 and 5 year returns when you come out of a recession or a 20% drawdown are typically very robust. So that's why we feel better about our portfolios going forward. Thank you very much for your time.